This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. A choppy week draws to an end. Mary Daly says the Fed has more work to do to control inflation, even after data for July showed modest price increases. Meanwhile, the UK economy delivered its strongest growth in more than a year, a surprising show of resilience that will keep pressure on the BOE to raise rates further. And U.S. President Joe Biden warns that economic problems have turned China into a, quote, ticking time bomb. Welcome to Bloomberg Surveillance. This is the Friday edition of the Early Edition. I'm Dani Berger in London with Kriti Gupta in New York. Kriti, it's only fitting that the 10-year yield did a round trip, not just yesterday, but for the full week. It exemplifies these fearful and edgy summer markets.
Yeah, I mean, look, you're seeing very low volume when you come to just simply in the equities market and the bond market. I think the stat for the equity market, Dani, is something like only 40% of normal trading. So you are already seeing that summer volume kick in. But to your point, you're also seeing that bond volatility kick in. And that's really where you're seeing those round trip moves, given we do actually have a lot to move the bond market story. You've got geopolitics on the one hand, monetary policy on the other, not to mention the digestibility of all of these treasury auctions. We're going to dive into that in just a moment. A quick check on these markets, though. Futures virtually unchanged right now. And that's interesting because just a few minutes ago, we saw a bigger pullback in the equity market, perhaps reversing just a little bit. But again, summer trading. So really keep an eye on where futures end the day. 44.82 here. And again, it is a Friday, so to see a little bit of cashing out wouldn't be all that much of a surprise. When it comes to the bond market, though, I think the most action that you are seeing this morning is coming on the front end of the curve. The 2-year yield at about 481, already a move down about 4 basis points there. And again, there's a lot to digest. So we're going to get PPI data out later this morning as well. So you are going to see a little bit, again, of the volatility that Dani was just talking about. Let's talk about what happened in Asia, though, because we did get headlines here that you are now seeing new yuan loans at the lowest since 2009. And that is moving the offshore yuan. 724 is what we'll call that pair for dollar yuan. It looks virtually unchanged right now, but if you were to look at an intraday chart, it would show you a bigger move, really saying that, look, perhaps that loan market is slowing down. That isn't the amount of kind of strength that we are looking for from China at the moment. We're going to dive into that shortly with a reporter as well. And of course, always worth checking on the commodity market. 86 handle on Brent crude, virtually unchanged at the moment. But again, the volatility is what matters. We did get comments out of the IEA today as well. They said, look, there is global demand, it's robust demand, but OPEC also has a lot of spare capacity. So really keep an eye on what Brent crude does, Dani.
There's a little bit of a head scratcher with that as it relates to European markets, because despite the fact that Brent, as you could see, there's a little change, that commodity markets aren't doing too much today. Those types of stocks, the commodity producers, the basic materials, energy stocks, are some of the worst performers today in Europe. And that's why the overall European index is looking weaker by about 0.7%. Perhaps it is just the fact that when Europe was closed yesterday, we got that slide in American equities. Of course, they didn't close lower, so part of it perhaps is catch up. But this interesting dynamic is arising after yesterday's CPI reading for not just the U.S., but the UK, where the inflation data is starting to look more promising. It's starting to come in line. And it seems like the concentration is now moving more towards the economic data. We got UK second quarter GDP and doing better than expected. Immediate reaction in sterling to strengthen versus the dollar. Your cable rate going up by 0.2% at 127. Meanwhile, in bond land, again, not a lot happening here. We are looking at continued selling in the German 10-year yield. Also, perhaps, Kriti, just another reflection of what happened yesterday when we got bear steepening across the board, kind of unwinding the initial CPI reaction.
Well, speaking of that CPI reaction, the data isn't over, Dani. We're also now going to get that PPI data out of the U.S. as well. After that, to your point, a slower core CPI figure. And this, of course, comes as Fed officials, well, they're staying pretty focused on their fight against inflation. Take a listen to their latest remarks.
To be sure, we are at a watershed moment in our economy. And I'm not just talking about the fight against inflation, in which we are making progress.
It's also consistent with what we believe will be happening, which is that inflation will gradually make its way down. But it is not a data point that says victory is ours.
We have been working hard in recent months to reduce inflation.
There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
For more on that story, let's bring in Bloomberg's Valerie Teitel. She is monitoring everything going on in the bond market right now. Valerie, there's a lot of cross currents here. We've got the CPI data, the PPI data, and then there's just the question of how well the market can actually digest the wave of Treasury issuance we got this week. Walk us through it.
Yeah, that's right. Yesterday, the follow through to CPI was so much focus on the 30-year bond auction that happened yesterday afternoon, came in weak. And after that, we saw the big reversal of this bid into bonds after that weak CPI print. It's even following through today. If you look at how the Treasury curve is trading, it's really that 30-year bond that's the weak point on the curve. It seemed to be a lot of excitement from traders from the market to reload into these steepening positions now that we have the CPI and that 30-year bond auction out of the way. We do have PPI today, Kriti, and the risk is that it shows us a different narrative. Now, higher oil prices, higher energy prices tend to have more of an impact on PPI, so there is a risk that it does come in hot based on that. Now, we didn't see that in yesterday's CPI print, so it would change the narrative slightly. We also get UMISH inflation expectations. We know those are very much tied to prices at the pump, which have been rising recently. So perhaps later this afternoon in this data dump from the U.S., the narrative does change slightly.
Has the narrative changed, Valerie, for the UK with this second quarter GDP print now in hand that was stronger than we'd been expecting?
A strong set of data from the UK across the board. Now, that growth surprise does bring with it some inflation risks, but I mean, better than expected data across the board. Industrial production, manufacturing production stronger than expected. And the reason for that uptick in that GDP for June was consumer spending. It saw the biggest increase in over a year. We know that if the consumer is still out there spending, that's pressures on core inflation are likely to subside a bit longer. Hence, we saw, such a rise in UK yields and that drag higher in sterling, which you pointed out earlier. But again, surprising to see this from the UK. We have had a string of weak data. Maybe that's done for now, and we refocus a bit more on its growth impacts of inflation.
Someone sent to me this FT article that basically showed in the UK, if you stripped out London, per person, growth in the UK is worse than Mississippi. So that's how it would rank compared to the U.S.
It's us here in London
that's
keeping it
you
strong.
And me. You and me, exactly. Yeah, I think that's right. The Americans in London. Valerie, thank you so much. Valerie Teitel there with the latest eco data. All right, let's move over to Switzerland now. And taxpayers in the country are no longer bearing any risk related to the rescue of Credit Suisse after UBS voluntarily decided to end an agreement with the government to cover losses. They've also repaid a loan they received. For more, let's get to Bloomberg finance reporter Marian Haftemeyer in Zurich. Marian, why and why now?
It's a good question. So why, for UBS, this is really a show of strength. You see the share prices going up today because of this announcement. They are essentially saying, you know what, after finally doing the due diligence on Credit Suisse, we think we can handle this and we don't need the government help. Now, this is probably a quite welcome decision from the Swiss taxpayer because they were on the hook for potentially, if there were going to be more than 5 billion and 9 billion of losses with respect to this deal. It also helps UBS, from their perspective, say, you know what, this is purely now a commercial private transaction and the government doesn't have a role in this anymore. And so they are freed, so to speak, to do what they need to do, want to do to make this transaction work.
Marian, is there any world in which UBS needs to actually reach out to the Swiss government again, where maybe they will actually need that financing? What is kind of the doomsday scenario here?
I think that probability is very, very, very low at this point, else they would have kept that guarantee. I mean, keep in mind, this guarantee only actually kicked in after UBS first took 5 billion in losses. So we're looking at like a $14 billion loss scenario. And for them, they've had a couple months now. The merger officially closed in June. They've had a couple months to really dig into all the things they thought might be concerning at Credit Suisse and have realized, you know what? We can handle it. I don't know if that means they're going to reach the 5 billion, but they certainly didn't think they were going to go over 5 billion and therefore tap into this government guarantee. So in terms of going forward, I think we can trust that things will not get to a point where they need the government to get back involved.
And that's pretty quite clear as you're already seeing the market trade higher. I think 5% shares when you look at those that UBS move. Bloomberg's Marian Haftermeyer joining us from Zurich. We thank you as always for walking us through the story. From Zurich, we go to the Pacific, or at least Washington's take on the Pacific. President Biden blasting China's economy just days after signing an executive order to regulate U.S. investments to the nation. The president called China's economic problems as, quote, a ticking time bomb and referred to Communist Party leaders as, quote, bad folks. Let's get more from Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins joining us right now from Hong Kong. Quite a turnaround for President Biden. Rebecca, what is he thinking?
Certainly some exuberant comments there, and also worth noting to a home audience, so not to sort of an international audience on the world stage. But as you say, some of his most direct criticism of China yet, and some things that were just wrong. His sort of number about Chinese growth, for example, the number of the population who's retired was off by several hundred million. So it's certainly not necessarily a comfortable place for Biden to be. Worth noticing, though, that there's been very little response from China so far, either on social media or local media. And you sort of have to wonder if China's avoiding forcing a situation where it has to respond to this. But the timing is interesting, as you say, because it's just come off the back of that executive order, which actually some may say that Beijing probably sighed a bit of a relief over that. It was slightly more targeted, narrower than was expected, and exactly precisely along those lines that we think Beijing was sort of lobbying Janet Yellen on during her visit to Beijing recently.
Rebecca, we're still on Country Garden watch. Officially a penny stock now, dropping again. I mean, it dropped 6% today, but that is a loss of 6 cents. So that's important context there, looking at those losses. We knew that China regulators were going to be meeting with different property developers, though not Country Garden. Where do we stand on this? Has the dial been moved at all at this point, or are we in still max concern mode?
Well, I think for Country Garden itself, clearly you can see that investors, looking at the bonds, for example, are pricing in not just a default, but a scenario where they really return very, very little in any kind of restructuring scenario. The notes are around 6 or 7 cents on the dollar. Just to put it into context, Evergrande sort of about 5.4. So I think you already have sentiment really reflected in the pricing there. But more broadly, I think emphasis will shift longer term, that if we do see really strained finances at Country Garden, even if they avoid an official default, there will be this focus on whether or not Country Garden is going to be able to deliver all of its homes. It has 4 times as many projects as Evergrande, about 80 million square meters of pre-sold apartments that it needs to deliver. And there is this slight social unrest issue too. We saw these mortgage boycotts happen when Evergrande defaulted and failed or struggled to deliver homes that already sold to people in China. So just a couple of things to watch.
Well, speaking of things to watch, Rebecca, the story that caught my eye out of China among the deluge of news coming out of the Pacific at the moment is that thousands of hedge funds in China could potentially get shut down. Let me read this quote, if I can, for our audience. About 37% of all existing hedge funds are smaller than even half of the 10 million yuan minimum asset requirement. Rebecca, this is a massive change when you're looking at the hedge fund universe. How does this play out?
Absolutely. This is a really interesting story. I'm glad you flagged it. Yeah, it looks like these rules that are going to come in as soon as September, essentially going to wipe out or force a lot of these smaller players to liquidate, and then also impose stricter rules on the larger players. Now, over the last decade, the hedge fund industry in China has really grown about 7-fold. And compared to its sort of global other comparisons, it does have a sort of more populated, more densely populated landscape. But we have seen Beijing over the years kind of look to try and professionalize and consolidate in these types of industries. So really looks like hedge funds are going to be the focus for now.
Rebecca, thank you so much for all of that. Rebecca Chung-Wilkins in Hong Kong. Now, coming up, we're going to be catching up with Aberdeen Investment Director Luke Hickmore later this hour on how he's thinking about markets after that CPI report. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Let's get to some important developments from the U.S. and around the world. Starting stateside, the Supreme Court agreed to hear a U.S. appeal of Purdue Pharma's $6 billion opioid settlement. The Biden administration contends that the accord improperly shields the Sackler family, a member who owns the company. The high court review could threaten Purdue Pharma's bankruptcy reorganization plan, which includes the opioid settlement, as well as an agreement by the Sacklers to give up ownership of the company. Dani, this is an enormous story. Of course, we know the Sacklers have been associated with the opioid crisis in America. Now, this halting from the Supreme Court could mean that simply their move or their litigation is long from over.
Now, elsewhere in the U.S., Kriti, Hawaii's governor says 53 people have been killed in wildfires that tore across the island of Maui, with that number likely to rise. Fast-moving flames swept the island, destroying hundreds of buildings and sending people fleeing into the ocean to escape. The National Guard and Army have joined search and rescue efforts, with the main fire now 80% contained. President Joe Biden says he is rushing federal support to Hawaii.
I've ordered all available federal assets on the island, including the U.S. Coast Guard, the Navy 3rd Fleet, and the U.S. Army, to assist local emergency response crews along with the Hawaiian National Guard. We're working as quickly as possible to fight these fires and evacuate residents and tourists.
And from Hawaii, we go to Iran. Iran has moved 4 U.S. citizens from prison to house arrest as part of a potential swap. Joining us for more on this historic story, Bloomberg's Patrick Sykes joins us. Patrick, walk us through the latest updates. Where are the prisoners now? Are they free? What do we go from here?
That's right, yeah. House arrest is the key point there. They've been released from prison, but they're very much still in the country and they're under house arrest in Iran. That's interesting, and it differs from previous prisoner swaps or prisoner releases, where usually we've only found out about them when they leave the country and it's a done deal. In this case, it looks like things are going to be a little more sequenced.
What are the details that still need to be agreed upon, Patrick?
Right, so the Iranians are saying they want $6 billion of frozen assets that are held abroad to be released, and they're saying they won't release the prisoners until they get that. And that's oil money that Iran has from its oil sales abroad, but which it can't access because of US sanctions. And the prisoners are only going to be exchanged after that. Exchanged, also an interesting point. The Iranians calling it a prisoner exchange, the US not using that language. So we've also got to watch for, from the US side, who are they going to release and when are they going to release those? Any hiccups in that sequencing could risk a broader deal.
Patrick, you make a crucial point, essentially that there are so many hiccups here. Is this the start, though, of perhaps some more kind of diplomacy between Iran and the U.S., just given they're not exactly on speaking terms?
Quite. I think this sequencing that I mentioned, it's testament to the real lack of trust between the two sides, especially after the effective collapse of the nuclear deal. So the answer to that question depends if things go smoothly, if everyone does what everyone else expects of them when it's expected, then I think there's room to build some trust, and perhaps from that they can leverage some broader diplomacy. But if there are surprises, if the Iranians don't like the timing, if the Americans can't handle the political messaging of potentially releasing funds to Iran around an election cycle, then there's room still for things to fall apart.
Patrick, thank you very much for that update. That's Bloomberg's Patrick Sykes in Istanbul. Now, coming up, Telecom Italia rises as the Italian government signs a prelim agreement with KKR to grab 20% of the company's network. We'll have more on that story next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London alongside Kriti Gupta in New York. Now, some deal news. KKR has agreed to include the Italian government in its 23 billion euro bid for Telecom Italia's network. The Treasury may get as much as 20% of an asset it deems strategic. Now, Kriti, this is Giorgia Meloni's second major move this week. Earlier, in a move that upset Italian banks, it imposed a windfall tax on the banks. And again, it's really significant how much of corporate Italy she really has her hands on in this moment. When it comes to Telecom Italia, they do consider this a strategic asset. So for any deal to come through, Italy really wants that veto power when it comes to things like, certain assets, buying, selling. But originally, Kriti, the media reports from local media was that Italy would get a 35% stake. We're just talking 20 now. So perhaps for Italian government watchers, it's a bit of a disappointment. They're not going to get as much from this deal as initially expected.
Yeah, I think the broader context is important too, Dani, because it's not just KKR that's looking at this, for example, or the Italian government. It is also the likes of Vivendi, for example, the major telecom company coming out of France as well. I also have to mention, this is something that has been a sticking point in Italy for almost a decade. This infrastructure that they haven't really been able to fully develop and fully kind of advance in an era where even stateside you're seeing the 5G network, for example, get a really big boost. Italy is far behind, and a lot of that is simply because they're shifting the strategy and the plan on how to actually tackle that, and this won't necessarily help.
Yeah, and on the Vivendi front, they are Telecom Italia's largest shareholder, and their sticking point has been, hey, we say this thing is worth 30 billion euros. Last time KKR looked at it, it said it was worth 23 billion euros, according to the deal plan with people familiar at the time. So Vivendi not too happy about that one either. All right, coming up, we're going to be speaking to Aberdeen Investment Director Luke Hickmore. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A choppy week draws to an end. Mary Daly says the Fed has more work to do to control inflation, even as data for July showed modest price increases. Meanwhile, the UK economy delivered its strongest growth in over a year, a surprising show of resilience that's going to keep pressure on the BOE to raise rates further. And meanwhile, in the U.S., President Joe Biden warns that economic problems have turned China into a, quote, ticking time bomb. I'm Kriti Gupta in New York with Dani Burger in London. Dani, some powerful words coming from the president there. He's also juggling, of course, the wildfires in Hawaii, the Iran prisoner exchange as well. And yet the markets seem fairly quiet.
I got to say, it feels kind of silly to talk about what European stocks are doing right now, and we're talking about prisoner exchanges and fires. There's a lot of important things happening in the world, but we are Bloomberg, so we got to give you a check on what's happening on these Friday markets. They do feel squarely like Friday summer markets. I mean, not a lot to move them, right? We're kind of mostly done with earnings. We got the big CPI report out of the way yesterday. We are drifting lower in the European session, down about 0.7%. The one thing that was able to shake things up today was that UK GDP report for the second quarter coming in stronger than expected, perhaps giving the breathing room for the BOE to hike more. Maybe breathing room is the wrong word, because, surely they are concerned about needing to hike more, about the issues of getting inflation under control. It's remarkable how much the economic data is taking the mantle of importance away from CPI data, away from other inflation data. Sterling strengthens about 0.25%. Meanwhile, German 10-year yield following a lot of the action we saw yesterday in the U.S. in terms of declines. Yields are up by about 4 basis points. Again, we saw that big bout of bear steepening yesterday, Kriti.
It's interesting that we're seeing that kind of acceleration of selling in Europe, because when you look at what's going on stateside, it's not the same, Dani. You're seeing futures down, marginally, down 0.01%, 44.85 on those contracts. A little bit of underperformance from those NASDAQ futures, though. The bond market gets interesting, to your point, because we, of course, have that PPI data later in this morning. 2-year yield at about 4.81, moving down by about 3 basis points. But again, the PPI data could change that. What happens if it's at odds with the slowing CPI numbers we got yesterday? Let's talk talk a little bit about what happened in Asia overnight, though, because if we're talking about a potential slowdown in the inflationary or even the growth dynamics in the U.S., we're certainly seeing them in China. China actually releasing that their new yuan loans are now at the lowest since 2009. That is not a metric that strikes a fun chord with a lot of investors. Nevertheless, that is weakening the offshore yuan. So you are seeing dollar yuan at about 724. We'll call it 725 this morning. Brent crude as well, also trading just shy of an 86 handle, down about 0.5%. The IEA coming out with some comments saying, look, demand is good, demand is robust, but OPEC does have spare capacity. So there is room potentially, if they choose, for prices to come down a little bit.
Kriti, I do want to show us what the session has looked like over the past 2 days with the 10-year, because just looking at the level we're at now really belies the volatility we saw yesterday. Okay, so here's your 2-day. The session is a little bit shorter today because Japan was closed this morning, so we didn't get the cash trade until a little bit later on. I digress. That big drop we saw in the middle of what says 10 there, in the 10th of August, was that CPI report. The initial reaction to core month over month hitting what was expected, showing disinflationary trends, was a relief rally. Now, if you, though, woke up today and didn't look at the trade, you would have expected that CPI came in hotter. Because about 30 minutes later, you saw the rally not only undo itself, but turn into a sell-off. We have come to a round trip. We've come back to 4% on the 10-year yield. It is a bit of a head-scratcher. Let's see if we can make heads or tails of it. Joining us now is Luke Hickmore, Investment Director at abrdn. Luke, I look at that. Do I say, look, this is a market that's decided inflation is going to reaccelerate? Or should I look at that and say it is the summer, markets are weird, there is no information contained within that price action?
I think it's possibly bits of all of that, which is always difficult to put your finger on one thing. However, I do think we're seeing this bear steepening trade. That's reflecting the market shifting to a higher for longer Fed view, maybe just 25 basis points more, but they stick there for a long time. That should steepen up curves. That pressure has been going on for about a month. It's probably one of our favorite trades, by the way, steepening trades. So that's going to push up those 10-year kind of numbers anyway, on top of which we had the 30-year financing yesterday, which was a bit soggy, and the action around it didn't feel very comfortable. And it was around that point that we saw yields start to tickle up in the 10-year, on top of which holiday, absolutely, that causes volatility.
Do you think this market, though, might soon shift to a grind lower in growth, Luke? And part of the reason I ask that is this narrative that's arrived around the fiscal support blanket that's been laid on top of the American economy, that at some point we run out of that and we face the reality of tightening monetary policy. Is that a reality? And will that begin to be a trade that's put into this market?
I've been looking for a recession for so long. It feels, I still think we're going to get there. I think all that's happening is we're just pushing it out in terms of time. And that fiscal comfort blanket is certainly part of the story. The high level of savings is part of the story. That great resignation that we've been going through since COVID is part of the story, all of which is fading. And I think as inflation comes down, of course, nominal growth comes down too. Revenues go back to kind of flat year on year, if not negative, as we get later into the year too. So I'm sticking with, it's really hard for the Fed to raise rates this hard without a recession coming along. There is very little evidence in history that they've been able to get a perfect soft landing once, maybe twice in 100-odd years.
Well, Luke, as we know, as part of economic cycles, recessions are inevitable. So at some point, you will be right. Let's talk a little bit about just the growth story again that Dani was talking about. She mentioned fiscal support. I'm curious about fiscal support as well, not from the U.S., but from China. If we look at the recovery in the last global financial crisis, a lot of that came from Chinese stimulus. Is the Chinese stimulus or the Chinese read-through the same as it was now as it was then?
No, I don't think it is. That rescue the world got during the global financial crisis from China was so important. I don't think we're there now. The growth potential in China is lower now than it was back in 2008, 9, 10. I think the more focus that they've had on domestic growth has changed the pattern a lot as well. And clearly, we've seen the early foothills of both onshoring and friend-shoring, shifting manufacturing away from China. So to get a stimulus to work, especially with the housing crisis that's been going on in terms of values in China over the last year or so, they need to do more to get the same level of growth. And I'm not sure they've got the appetite or maybe the capacity to do the amount that they need to do to get back to a 5 or 6 or 7% growth rate that we've seen in the past, just domestically. So it's really hard to think that spills over to the broader economy, which is what, of course, we saw in the GFC. So no, I don't think so this time.
You're talking about the growth spilling over. Let's talk about perhaps the lack of growth spilling over. The story of China actually exporting deflation. Is that something that's going to have a more powerful read-through? Is that something that the likes of Powell and Lagarde are actually going to welcome?
Of course, to a degree. But as I said, I think its impact has waned a lot more than it would have done in previous years. It's a bit like the oil story in the 70s. It was all about oil price and inflation. And now, we're a lower carbon intensive economy than we have been for a long time. And we are now a lower Chinese intensive economy than we have been for a long time. So it'll make a difference on the margin. But I think inflation comes back to the core domestic drivers, particularly in the US, wages, jobs, growth, consumers actually having the will to go out and spend.
Luke, in terms of what can really ignite volatility into this market, it seems like the point of focus keeps changing. At one point coming out of COVID or during COVID, it was jobs. It's been inflation, CPI figures for a while. Does that now shift, given our continued confusion and concern about a recession? Does that now shift to the growth data being the thing that you want to trade?
I think so. I think that narrative about a soft landing is going to be changing as we go through the next couple of months. It's seasonal as well. The September-October season can be pretty tricky for equity markets, rethinking their growth expectations. I think people are going to actually take them down quite a lot. On top of which, and the one that's not really started to be talked about yet, sovereign risk. We've seen one downgrade in the US. The amount of sovereign debt is still incredibly high. Lower inflation makes that actually a bigger problem for governments. We could well see more rating action on the sovereign side over the next year as well. And markets will need to react to that too. And that's a hard one when these are our risk-free curves.
Yes. Wait, can you walk me through that scenario? Is it further action on U.S. sovereign debt, or does this sort of begin a snowball effect of more global sovereign debt getting a relook?
Without being too harem-scarum, yes. So it definitely starts with the US. It definitely starts with the reassessment of political volatility that we're going to see next year. The amount of fiscal stimulus that we're still going to be paying for in the US for ages, of course. The amount of debt, they got the over 100% debt GDP kind of numbers that they're in. And this, of course, is nowhere near worrying about a default, but it only takes these small moves in rating agencies at the sovereign level, particularly in the US, to start rethinking the UK, France, Japan, all of whom have got very large fiscal deficits as a percentage of GDP. So I think that is something investors need to put on their radar, thinking about that sovereign risk over the next 6 months, 12 months.
Luke, we're about 4.5 months away from 2024 when the presidential cycle in the U.S. really kicks up. And then a few weeks after the presidential cycle, we're again in the midst of the debt ceiling debate. Is that something that the market should be worried about right now?
It always seems to worry about the debt ceiling debate as we get near it, and then we get past it and moves on. And it feels there is a point when that is going to become really, really sharp. And it has to be around the political cycle that is going to be so intense in the US next year. I think that is something, I haven't got the dates in mind, and I'm going to have to get completely up to date on the dates for the next debt ceiling debate, because I think next year's ones are going to make the ones we saw with the volatility this year look actually a bit of a walk in the park.
Oh, boy.
Yeah.
Not.
Sorry to be so negative, but, it's holiday.
It's a Friday, Luke. It's a Friday in the summer.
Sorry.
We need more cheer from you.
Yeah, the timing, not fantastic there, whoever scheduled that. Aberdeen's Luke Hickmore, we thank you, as always, for joining the program and keeping a little bit of modesty, perhaps, in these market calls. Coming up, Mexico kept borrowing costs unchanged for a third straight meeting. We're going to discuss that and more in the world of emerging markets. Graham Stock, BlueBay's Senior Sovereign Strategist over at RBC Global Asset Management, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London alongside Kriti Gupta in New York. Now, Mexico kept borrowing costs unchanged for a third straight meeting, pledging to maintain its current stance. Joining us now is Graham Stock, BlueBay Senior Sovereign Strategist at RBC Global Asset Management. Graham has over 2 decades of experience over in emerging markets, sovereign strategy, with a particular focus on LATAM. So, Graham, let's focus on LATAM. Look, Mexico holds in this decision, but we've already had a cut from Brazil, a large cut, I should say, from Brazil, from Chile. It's kind of ironic that despite that, I was just looking at a Bank of America survey of global monetary policy. The biggest concern is a mistake. What do you make of that? How vulnerable are LATAM nations at this moment to a monetary policy mistake as they embark on a cutting cycle?
I think they have some room. They've got much larger reserves than they had in the past. They've hiked rates aggressively in the tightening cycle. So there's quite a big margin between the real rates in LATAM and, say, in the United States. So there's some room for maneuver. Currencies have been quite strong, so there's room for a bit of weakness in the Mexican peso or the Brazilian real, for example, without that feeding back into an inflationary loop. But at the same time, they want to make absolutely sure that they bear down on inflation expectations. And that's why Banxico kept rates unchanged at 11.25 last night, as you say, for the third meeting in a row. And why they signaled that they're going to remain data dependent and cautious around the outlook until inflation expectations come back into line with their target.
You mentioned the weakening dollar. It does feel like it's run out a little bit of a steam, or at least we've taken a slight pause in that trend. How necessary is it that we continue to see dollar weakness in order for LATAM nations to have that breathing room to continue to cut?
I don't think it's a precondition. I think the more important element is the domestic inflation dynamics. Some of the price pressures from high food and energy prices are falling out of the indices quite quickly now. But the key is whether core inflation starts to behave better. So just like in the US, like in Europe, core inflation is the concern, and that's the reason why inflation expectations are still above targets in many cases. It was striking in Banxico's statement last night that for the first time they did mention peso strength and the impact that's had on inflation over the last few months. I think they can tolerate some weakening of the peso, strengthening of the dollar without worrying too much. But again, they need to see those forward-looking inflation expectations coming down further. I would expect them to be ready to cut probably in November, but maybe not even until the beginning of 2024.
Graham, you mentioned essentially the super peso, and it's such a popular trade at the moment to kind of capture the carry in the Mexican peso or even in the Brazilian real versus a currency like the Japanese yen. But I'm curious how much of that risk appetite is going to wane if you start to see a lot of these Latin American central banks pull back and perhaps signal a pullback in some of the developed world as well.
I think, again, that they have quite a big cushion to work with. So in Mexico's case, for example, with the policy rate at 11.25, and inflation running at just below 5%, the real rate is 6.5. So that compares very favorably with the US real rate ex post, which is around 2.3. In Brazil, the real rate is even higher because inflation is running lower and their policy rate is higher. So I think they have plenty of room to cut without jeopardizing that carry trade. But it is something that they'll certainly be mindful of. And again, though, it's the domestic inflation dynamics that are their key driver here. And that's why that's the data that they're going to be watching in particular. Mexico, of course, has been favored by relatively buoyant activity. Remittances have been very strong as a result of the strong US labor market. We're seeing some nearshoring, which your previous guest mentioned, relocation of manufacturing activity away from China to Mexico in particular, but also other parts of the region. And that's all helping activity. That means that your core price pressures will remain for a while. But as the temporary price effects from the the conflict in Ukraine and from COVID reopening start to fade or continue to fade, that should be supportive. The one risk factor, the additional risk factor that I think we need to keep an eye on is El Nino and the impact that could have on food prices, which again should be temporary, but particularly in Latin America and indeed other emerging markets where food is such a big component of the CPI basket, it's not something that central banks can look through entirely.
Graham, you read my mind. I was just about to ask you about those food prices, because if you actually do look at them, they've come down a little bit, but not as much. And the exposure, as you mentioned, is enormous for the world of EM in a way that it doesn't necessarily have the same read-through to the American or even the European consumer. What does the Federal Reserve, or excuse me, I should say a central bank, an emerging market central bank, actually do about that? Because rates aren't a direct tool to tackle food inflation.
No, absolutely. And so they have to keep their focus on core measures and on inflation expectations. And that's why they've hiked more aggressively through the hiking cycle. They started hiking faster than developed market central banks. And now they're in a position to consider easing again. But because they have taken that aggressive action, they hiked in bigger increments. And again, Mexico's policy rate is 11.25%. Brazil's is close to 13. So there's plenty of cushion there. They've moved aggressively already, and they're going to be cutting with extreme caution, again, as we saw from Banxico last night.
Graham, a final question on the politics of it all. Of course, we're watching the political situation in Ecuador unfold after the assassination of one of the candidates. What is the read-through in terms of the markets when we're looking at that kind of volatility?
Unfortunately, political noise is something that we're used to in emerging markets. This is an extreme example in Ecuador's case. But I think they probably will hold the elections as planned on August the 20th. It could even lead to a more market-friendly outcome if some of the other centre-right candidates are perceived as being tougher on security. But it's a scourge for the region as a whole. There are huge concerns around the security situation, particularly fueled by drug gangs, driven by demand for drugs in the developed world. And it's something that Ecuador has not yet managed to tackle successfully. It took Colombia a very long time to address this, dating back to the late 80s. It's a continuing problem in Mexico. It's something that's on the radar for the political systems all across Latin America, but is again a very difficult thing to address. But again, I think the elections will go ahead there on the 20th of August. We've got primaries in Argentina this coming Sunday, which will be an important signpost on the road to the general elections in October there. I think the general theme in Latin America is still a desire for change. So whoever the incumbent is going to face a very difficult battle retaining power in these elections, because they're simply not managing to satisfy popular demand, whether it's for security or for improved living standards. So we would expect a change of government in Ecuador and also a change of government in Argentina when those elections roll around.
Certainly a lot to digest in the EM world. Graham Stock all over that. BlueBay Senior EM Sovereign Strategist over at RBC Asset Management. We thank you as always for joining the program. A lot to digest on the macro and micro front. Stick with us. Your trading day ahead. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Dani, it's a little bit quiet in the markets, but there is still a couple of things to watch. Of course, we have those PPI numbers coming up at 8:30 a.m. New York time. You also have Neil Kashkari speaking over at about 11 a.m. New York time. And of course, the Fed minutes coming out next Wednesday as well. I got to come back and circle about the PPI because I think this is really important. We put so much emphasis on the CPI story, and now we got to talk about producer prices. I'm reading our Anna Wong, our chief U.S. economist, kind of preview of this. She's talking about higher oil prices, higher shipping costs stemming from the Panama Canal. Dani, this isn't something we talk about, but there's a very real read-through into the numbers we might get today.
Yeah, and look, if there's any surprise to the upside, it kind of challenges some of the narrative that the CPI laid out yesterday. But it's clear that this market unwound positioning for re-acceleration of inflation and then put it right back on. I think it was really interesting what Luke Hickmore said about this idea that it's not necessarily the inflation data that's the important thing anymore. It is the growth data, as Thanos Van Vakidis over at Bank of America just put it in a note. we don't believe in miracles. They don't believe in the miracle that inflation can be coming down without growth taking a hit. So it's that growth data that's starting to become more important, Kriti.
Yeah, and where's the read-through from around the world? Perhaps something that Surveillance will digest ahead. That does it for Early Edition. Tom, John, and Lisa take it from here. Stick with us. PPI ahead. This is Bloomberg.